Well, last few months, if you go back even through the spring of 2010, is really simple. We had a lot of people very, very afraid of anything to do with money, the economy, afraid for their jobs, for their own security, retirement. It was one of those turning points, I think, in American history, where people really started to look long term and think maybe what we thought was the case is not reality. There was a rolling up of amount of fear that really hasn't been seen in decades. And I think it's because the last 10 years, the stock market has done very poorly. The job market just kept getting worse and worse and worse over the period of the last couple of years. And they don't see any signs out the window of things getting better. They hear the mortgage crisis, there's all these foreclosures. They hear that people are still getting laid off. They hear taxes are going to be going higher in January. The stock market's still at 10,000. There's nothing out there, at least they don't think, that tell them, hey, we should be looking at more positive sides of life right now. So that's what's been physically happening. A lot of bad news feeding into the already existing psychology of, I'm not really positive anyway. Well, we were right. In addition, not only were we right about the stock market and what we thought was going to be happening, we really put it out there in a way for people that they could get a hold of it. We've been writing for At Geist magazine, which has been done a great job distributing it out to a lot of people that we like to communicate with, people in Fishers, people in Carmel, people of Hamilton County. This is where we live, this is where we raise our kids, this is where we grow our business. And we're excited for the chances to keep putting good information into their hands. And good information, back in April and May when the stock markets were getting hammered, we said if you sell at these lows, you're going to be taking a big risk. You're going to be taking a big risk. You're going to be losing a lot of upside opportunity. And then again, in July, August, when the markets were selling off, we kept saying, stay with the stock market. This is where you're going to be making some money. It not only has rebounded past a lot of those points, but it's just a small amount away from hitting a new multi-year high. So obviously you want to stay with what we were talking about. Now we actually do things in a manner, Tom, that is completely different than almost any of our competitors as far as we know. We do not take the time to look at things like a balance sheet of a company. We don't really care about what a profit and loss is of an individual corporation. We don't care how much debt a particular company has. We're not interested in the story. We have no interest in what a CEO is telling everybody. Because a lot of times words in that case are worth far less than actions. The entire Samex principle is based on a few different things, grounded in the oldest economic principle known to man. It's supply and demand. Supply and demand works in the stock market the same way it does in any market, except in an economics class, they just don't really understand that nor admit to it. It's very simple. They're going to study supply and demand of the real estate market or the supply and demand of orange juice, but they're not going to take it into the stock market. We do. We take the concept of supply and demand. That's what drives stock prices higher if supply is lower than demand, just like any other market. And we study that from the top down. We look at all the major markets in the United States, Latin America, Europe, Asia. Now Africa is playing a bigger role in this. We look at all the different sectors in these major stock markets and industry groups. Again, supply and demand equations. What are people doing with their money? Are they buying more than they're selling? I don't care what they say. I only care about what they're doing with their money. Every single trade gets put on a tape or on the chart. Those are the things that we study to find out what we think is going to be happening in the future. We think this is one of those turning points in our American history. We really do. And if you look at what is going on, at least coming into the election, people that are friendlier to businesses, people that are friendlier to stock markets and investors, and less government regulations, they seem like they're gaining a lot of support and a lot of ground. And I think one of the reasons that the stock market, the Dow Jones that is, has rebounded from 9,600, where it was in the summer, and we said stay with it, and it's back over 11,000 now, which is a pretty strong rate of return in only a few months. That's one of the reasons, because people see better times coming down the road. Now, the job market is still a mess, but it hasn't gotten worse for a little while. The housing market's still a mess, but it hasn't gotten worse for a little while. And now with friendlier people in legislative bodies, not just in Washington, D.C., but governor mansions all over the country, we think we're going to see a tidal wave that is going to build up and is going to give support to what the stock market is telling us, and that's better times going to be coming down the road. So that's the next few months. What we tell people to do is hold on to your stock market holdings, add to equities if you see some dips coming up over the next couple of months, and please be very careful of the bond market. It's something I've been writing about since April in At Geist. We've cautioned people about fixed income. The government can only borrow so much more money before interest rates start to go higher. When they do, there's going to be a real situation. It's going to be a problem. Investors are going to lose a lot of money in the bond market. And the losses are starting. They actually started to come in about a week and a half ago. Bond prices have been dipping lower and lower. We think that's only the beginning of what could be a real situation on the negative side for people. So stay away from fixed income. Don't put any more money in there. Watch out for bonds. Reassess everything in your portfolio over there. Buy stocks on dips and stay with them for the next few months at least.